Okay, welcome to the deep dive. If you're tracking India's huge energy transition, you know the real challenge, well, it isn't just building the solar farms, is it? It's getting that power across the country,
Yeah,
connecting it. The real bottleneck and maybe the real opportunity, it's that high voltage transmission stuff.
exactly right. Yeah. And today we've really dug into kind of the engine room of that transition. We looked at the latest Q2 financials, a big capital investment announcement, and crucially, the earnings call transcript for GE Vernova T&D India Limited, GVT&D.
Right, and our mission really is simple. I just connect the dots. How is this company's, frankly, explosive financial performance right now? How's that directly funding this massive, almost preemptive bet on India's future grid capacity?
Yeah, and the finding is pretty compelling, I think. You're looking at a company delivering record growth, high margins now, and immediately turning around and pouring nearly, what is it, 10.4 billion rupees into building out for the future. It's quite the move.
Okay, let's unpack this. Let's start with that Q2 scorecard. The numbers for Q2 fiscal 25-26, they are exceptionally strong. Revenue jumped 39% year over year, hit INR 15.4 billion.
And the first half revenue, same story, also up 39%, so 28.6 billion total for H1.
But like you said, the efficiency story is where it gets really interesting. Net profit after tax, the PAT, it didn't just grow, it more than doubled compared to last year.
Yeah.
Almost 3 billion rupees. INR 2,995 million, to be exact.
Right, and that profit margin, 19.5% PAT margin, that's up significantly from 13.1% last year.
And the operating level, the EBITDA margin, even starker, it soared to 25.8% for the quarter.
Yeah, that's a huge jump from 18.5% just a year ago. Really impressive.
So how do they do it? What's driving that?
Well, management basically cited three key things, three pillars for this. First, obviously, the sheer volume growth we just mentioned, that 39% jump.
Okay.
Second, and this is crucial, they secured much better pricing in past orders, so the contracts they're executing now are just, well, much more lucrative. Okay. So those decisions from maybe a year or two ago are really paying off on the bottom line today.
Exactly. And third, they're seeing real results from internal stuff. Productivity improvements, driven by pretty rigorous lean processes, they said.
So that 25.8% EBITDA, I mean, just putting it simply, for every rupee they earn, they're keeping almost 26% as core operating profit. That's the financial fuel right there.
It absolutely is.
And their balance sheet, it seems to back this up. They're debt-free.
Completely debt-free. And sitting on a healthy pile of cash, about INR 15.2 billion in cash and equivalents as of September 30th.
That's a serious war chest.
It is. And that cash position, it isn't just, a safety net. It's the direct power source for this big strategic move they just announced. Think about it. They converted their entire first half profit, that 5.9 billion INR PED, entirely into cash.
Wow.
Which makes this huge capacity bet possible without needing to borrow a single rupee. Okay, so let's talk about that bet, the crucial announcement from November 3rd. The board approved a major capital expenditure, CapEx, of roughly INR 806 crore.
Right, and just so you have the full picture, the 806 crore, it's actually on top of 140 crore they'd already announced back in May.
Okay. So the total plan is bigger.
Much bigger. It adds up to INR 946 crore. That's nearly 10.4 billion Indian rupees for the total expansion plan.
Almost 10.4 billion. That is a massive commitment. It signals huge confidence in what's coming down the pipeline. So where specifically are they putting that money? What are they expanding?
It seems very targeted, highly strategic. They're focusing on potential bottlenecks in the future grid build-out. So at their Vadodara facility, they're boosting capacity for transformers and reactors by more than 50%.
50% plus. Wow. Why such a massive focus on those two things specifically, transformers and reactors?
Well, because these are basically the biggest, heaviest, longest lead time items you need for moving bulk power. Especially for complex high-voltage projects. You simply cannot build a new HVDC converter station, for example, without these massive core components. So this investment, it's almost like they're pre-booking their advantage for those huge national contracts they see coming, getting ahead of competitors.
Okay, that makes a lot of sense, preempting the bottlenecks. What else is getting expanded?
At their other sites, Hosur and Padapai, they're expanding capacity for high-voltage switchgear. We're talking gas-insulated switchgear, GIS, and air-insulated switchgear, AIS.
Right, the complex stuff inside modern substations.
Exactly. Needed to safely manage and direct these huge power flows, they're increasing those capacities by up to 25%. Plus, the Hosur facility is adding totally new lines for some specialized components like air core reactors and bushings.
Got it. And crucially, this whole massive investment, it spans 3 years, right? tentatively finishing end of 2028.
Yeah, about 3 years. 2026 through the end of 2028 is the timeline they mentioned.
And it's all being funded, as you said, through internal accruals. Cash they've already generated, funding something this big entirely with cash. I mean, it sounds incredibly disciplined, but does that maybe risk tying up capital? Could it constrain their shorter-term flexibility?
That's a really sharp question. You're asking about the opportunity cost, right? Clearly, management is betting big on the long term here, prioritizing capturing that future market share over, say, generating short-term returns on that cash pile.
Hmm.
It signals absolute conviction. They must believe this high demand cycle isn't just a blip, it's sustained multi-year. They seem convinced this capacity expansion is the single best use of their capital right now, that the market is going to be tight enough, undersupplied enough to justify locking up nearly 10.4 billion rupees for 3 years.
That level of conviction, it must be rooted in what they see coming. The current order book, the backlog, certainly seems to support it. As of September 30th, the backlog stood at, what, INR 131.1 billion?
A very robust INR, 131.1 billion, yeah.
Hmm.
And that's significant because, well, it's roughly 3 times their revenue from the entire last financial year.
3 times.
That kind of visibility, it doesn't just lock in future revenue, it also gives them a degree of pricing leverage for the next few years, you'd assume.
Now, we do have to address the number that probably raised some eyebrows. The Q2 order bookings. They were reported down 66% compared to the same quarter last year. On the surface, that looks like a major slowdown.
It looks alarming, absolutely. But the context management provided on the call is absolutely critical here. You have to strip out the noise, the anomalies. See, the prior year's Q2 was massively inflated. There were about INR 31 billion worth of huge one-off deals in there.
31 billion.
Yeah, including a major export contract and some large software orders. If you take those unusual, very large items out, then the current quarter's booking level is actually considered in line, as they put it, with their normal base business performance.
Okay, that completely changes the perspective then. It wasn't a collapse, just a comparison against an unusually high quarter.
Precisely.
And what's maybe just as reassuring is the quality of that huge backlog they do have. You mentioned 97% of the secured orders are from pretty low-risk customers. Private companies, central utilities, strong public sector units.
Yeah, exactly, which
Yep.
means their exposure to, say, state utilities, which, sometimes carry higher payment risks, that exposure is tiny, tightly controlled at just 3% of the total backlog.
That says a lot about discipline, doesn't it, in choosing which contracts to take on.
It really does. Risk management in action.
So looking ahead, management seems pretty bullish. They expect the domestic pipeline to strengthen significantly. They even cited specific projects identified by the National Committee of Transmission. But the really big structural driver, it feels like, is HVDC, high voltage direct current.
Oh, absolutely. HVDC is basically non-negotiable if India wants to meet its energy goals. You just need it. It's the only really efficient way to transmit massive amounts of power over the very long distances involved. Connecting those remote renewable energy hubs way out west or down south to the big cities and industrial centers where the power is actually used.
Right. And GVT&D is right in the thick of it.
Seems so. Management confirmed they're actively involved. The Southold project, they said, is currently under evaluation, and they expect tenders for the next big one, the B to South Column project, probably next quarter, fiscal Q3.
Okay, so the core grid business looks strong, but they're also diversifying that pipeline, aren't they? You mentioned data centers earlier.
Yeah, and this is another really interesting angle. Beyond the big state and central grid projects, they're seeing this burgeoning opportunity from data centers.
Which makes total sense. All that digitalization, urbanization,
Yeah.
it requires massive, reliable power, often built out very quickly.
Right. And a typical large data center, say 200, 300 megawatts, that represents a potential order pipeline of, get this, 75 to 100 crores just for GVT&D's kind of products.
75 to 100 crore per data center. Wow.
What products are we talking?
Things like their GIS switchgear, transformers, substation automation systems, all critical components for powering a facility like that.
Yeah.
It's a specialized, probably high-margin segment, and it's growing incredibly fast.
So that really shows they're positioning themselves broadly, not just as a supplier to the national utility, but as a key infrastructure partner for big private industry builds, too.
Definitely. And management specifically said they expect fiscal years 27 and 28 to be a much bigger story. for this data center segment. It's clearly a major growth focus.
Which brings us back full circle to why they're making that huge 10.4 billion rupee bet on expanding capacity now. It all connects.
It ties directly into the entire national energy roadmap, doesn't it? You've got that incredibly ambitious target, 500 gigawatts of non-fossil fuel capacity. You've got peak power demand expected to climb something like 80% by 2032.
80%. Yeah. Plus, you have the really long-term demand stacking up. Another 90 to 100 GW of conventional power needed by 2035.
And that huge target for nuclear, 100 GLD by 2047. The transmission grid, the backbone, it has to be ready well before all of that comes online.
Exactly. Transmission doesn't care where the generation comes from, right?
Yeah.
Solar, wind, nuclear, coal. The grid is the essential medium.
Hmm.
By investing so heavily now in these long lead time, high-value components, the big transformers, the GIS, the reactors, GVT&D is positioning itself to be the critical supplier, not just for the next few years, but potentially for the next decade or more of this national build-out.
So, okay, let's try and wrap this up for you, the listener. What this deep dive really reveals is a company, GVT&D, that is masterfully leveraging its current really stellar profitability. You see it in that 25.8% EBD margin like Betch, leveraging that strength to make these massive preemptive investments, nearly 10.4 billion rupees in capex. And that spending is directly tied to supporting India's absolutely explosive national energy infrastructure goals. It looks like a play to lock in competitive advantage in high-value areas like HVDC, renewables integration, and, increasingly, that surging demand from data centers.
It's quite a strategic alignment, but it does raise an interesting, maybe provocative final thought for you to consider. Think about the timelines here. The company's own capacity expansion, the one they're funding now, takes up to 3 years. It won't be fully online until the end of 2028. Meanwhile, the massive national transmission pipeline, these huge projects we discussed, they stretch out much, much further. Remember that nuclear capacity target? Way out in 2047. So the question is, this current environment, this high-demand, supply-constrained market that's allowed GVT&D to get such healthy margins and strong pricing, how long do you think that sweet spot can realistically last? How long before new capacity, including their own, starts coming online in a big way and potentially starts to normalize the market dynamics? It's something to really mull over.